This video is meant to be an overview primer for self-employed or small business owners to better understand what goes into the tax side of running a business. Whether you're just making extra money through a side hustle, or you own a company with multiple employees, it's important to understand how to prepare your business throughout the year for taxes. This video is not meant to be tax or legal advice, and we always recommend that you talk to a tax or legal professional before making any decisions for your business. Gotta get that one out of the way. So taxes, they're not just a tax season topic. You need to understand your taxes to learn more about your business overall. But before we get into the tax forms, let's talk about the type of entity that you might choose for your business. One of the most important decisions that you must make as you start your journey towards self-employment is determining what your business structure will be. You need to determine this as there are so many critical steps to take before you start taking in that revenue. The entity that you choose has a big impact on how you run your company, from how you'll be taxed to whether or not you'll be held liable for your business debts. Now, realistically, I do get that many freelancers don't think very much about choosing an entity. You just start doing business without choosing how to structure your company, and then you figure it out later, right? And while this is totally normal, it does come with a major drawback. You'll end up with one of the default entities, which is a sole proprietorship if you're alone, or if you have partners, a partnership. And with that, these default entities might be perfectly fine for you. They really could be. But if you settle for them without weighing your other options, you might miss out on some of the perks that come with the alternatives. Let's talk about the first one, a sole proprietorship. A sole proprietorship is the default business entity for freelancers. This means that if you start working as a freelancer without forming an LLC or corporation, you'll automatically operate as a sole proprietor. Now, a sole proprietorship is easy and cheap to form and run, so it's an easy choice when you're first getting up and running. Plus, you can always go back and form an LLC or a corporation later, once your business becomes more established and you're earning more money. Because you and your business are considered one for tax purposes, you don't pay taxes or file tax returns separately from your actual business as a sole proprietor. You just report your income or losses on your personal tax return, the IRS Form 1040, and then you list out all of your business income and deductible expenses on Schedule C, profit or loss from business. Adding your business profits to any other income that you report, like interest income or your partner's income, gives you your total income, which is taxed at your personal tax rate. And if you incur a loss in your business, you can use that loss to offset other income from other sources. Now, as a sole proprietor, you also pay Social Security and Medicare taxes, which are the same taxes that employees and employers pay on your net business income. This is called self-employment tax and is usually 15.3% of about 92.35% of your profit. We'll talk a little more about that later. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Next up is the partnership. This is the default entity for a business with multiple owners. Like a sole proprietorship, it automatically comes into existence when two or more people start a business together. It's the default when there's more than one person. If you're going to run your business with other people, you cannot be a sole proprietor. Instead, there will be co-owners within the company, and those partners will jointly manage the business. A partnership does not typically pay taxes itself. Instead, the business income and losses are passed to the partners and reported on their individual federal tax returns. You'll need to file IRS Schedule E with your return, showing your partnership income and deductions. A partnership is required to file an annual tax return, Form 1065, U.S. return of partnership income with the IRS. However, this is just an informational return, letting the IRS know about your partnership's income, deductions, profits, losses, and tax credits for the year. Each partner must pay income tax as well as Social Security and Medicare taxes, aka that self-employment tax, on their share of the partnership income. Next up is the LLC. A limited liability company, also known as an LLC, is a cross between a sole proprietorship or partnership and a corporation. LLCs have become increasingly popular because they combine the informality, flexibility, and tax characteristics of a sole proprietorship or partnership within the limited liability of a corporation. The big difference here is that after you form an LLC, your business has its own legal existence that's separate from you as the individual. It's even considered its own legal person. An LLC provides its owners with limited liability, which means generally you won't be personally liable for any debts that you may have incurred through your business. Usually, a single member LLC is taxed the same way as a sole proprietor. You report profits, losses, and deductions on your Schedule C. If that's the case, the LLC is referred to as a disregarded entity by the IRS. And if your LLC has 2 or more members, it's usually treated like a partnership for tax purposes. Your multi-member LLC will prepare and file the same tax form used by a partnership, which is the IRS Form 1065 U.S. Return of Partnership Income. A C corporation is the most complex type of business entity to form and run. It's also the most expensive. Because the LLC and sole proprietorship models are way more common, I won't get into the traditional corporation too much. Just keep this in mind. You can get many of the same benefits that you get from forming a corporation by forming an LLC. C Corps pay income taxes on their net income and file their own tax returns with the IRS. They also pay federal income tax at a flat 21% rate, which is lower than individual rates at some income levels. And while a C Corp might be a better choice for a business that brings in substantial profits, it is not such a great option if you expect to lose money in the first few years. This is because you cannot deduct those losses from any other income that you earn, like your salary. An S Corp is the most popular type of corporation for one-person businesses because it can reduce the amount of Social Security and Medicare taxes that you might pay. And unlike a C Corp, an S Corp is not a separate tax-paying entity. For an S Corp, corporate income or losses are passed through directly to the shareholders. That means you and anyone else who owns your business. Normally, an S Corp doesn't pay any taxes, but it must file an information return with the IRS. This reports how much of the business earned or lost, as well as each shareholder's portion of the corporate income or loss. And with all that said, when you decide upon your entity, you should likely also establish a tax ID number for your business, referred to as an employer identification number. You can do this by visiting irs.gov and submitting your application online. It's a relatively simple process, and your tax ID number is typically given instantly. Now, as a self-employed small business owner, you need to get a basic understanding of the tax forms that you might encounter when filing taxes for your business. Here, we'll give basic information on the main forms and how you might use those. The 1040. Form 1040 is the standard IRS form that individual taxpayers use to file their annual income tax returns. This is the form where you disclose your taxable income for the year to determine whether you owe additional taxes or get a tax refund. When you go to TurboTax or H&R Block or really any other tax filing website, you fill out the 1040. They just present it through a series of checklists and questions to make it a bit easier. You can also go to irs.gov and complete it directly. As part of that taxable income, you disclose wages, salary, taxable interest, capital gains, pensions, and any other types of income. The more complex your tax filing situation, the more boxes on the 1040 that you'll likely complete. Now, the 1040 Schedule C. When you start a small business and you do not incorporate or form a partnership, you report the results of your operations on Schedule C and file it with your Form 1040. You calculate your self-employment tax on Schedule SE and report that amount in the Other Taxes section of Form 1040. In this way, the IRS differentiates the SE tax, self-employment tax, from the income tax. If you formed an LLC, this is only a state-recognized entity, so this is actually treated like a sole proprietorship on your federal tax return and filed this way as well. The Form 1040 is due by April 15th each year, unless you file for an extension or there's some other extraordinary circumstance. The W-2. Form W-2, also known as the Wage and Tax Statement, is the document that an employer is required to send to each employee and the IRS at the end of the year. A W-2 reports employees' annual wages and the amount of taxes withheld from their paychecks, among other items. The W-2 is typically the first form that you use when filing your tax return if you work for an employer. You input your total earnings for the year, along with the amount withheld in taxes. The taxes are separated into the withholding for federal income tax, Social Security tax, and more. If the amount of tax withheld according to the W-2 form is more than what you actually owe after you're done filing your taxes, you're issued a refund. If the amount withheld is less than what you actually owe, then you're going to owe the IRS. You should receive your W-2s by the end of January each year, assuming that you work for an employer. If you don't need to worry about that. All right, let's get into the 1099s. There are a wide variety of 1099s, and all kinds of taxpayers can get a 1099 for all kinds of reasons. All 1099 forms serve the same purpose though. They are used by taxpayers to provide information to the IRS about all the different types of income they receive throughout the year outside of their regular employer-based salary on the W-2. So for miscellaneous income, you should receive the 1099 miscellaneous income or non-employee compensation form if you worked for someone as an independent contractor or were self-employed, or simply ran a side hustle. If you freelance, were self-employed, or had a side gig, your client should send you this form if they paid you over $600. This is where the commonly used term 1099 employee comes from. It generally describes a person who, in the eyes of the IRS, is an independent contractor, also called self-employed or freelancer. Whereas the W-2 reports income paid to employees, the 1099 reports all types of income outside the traditional employer-employee relationship. Every business owner needs a profit and loss statement to better understand their business and properly calculate their net business income. You know what? When it comes to your taxes, your net business income is used to calculate your tax liability. A profit and loss statement is a financial report summarizing these revenues, costs, and expenses that your company incurs for a specific period. And this is typically done in intervals like monthly, quarterly, or annually. You essentially solve the basic equation for calculating profit. Revenues minus expenses equals profit. To create a profit and loss statement, you'll need all records of all cash flows going in and out that relate to your business. If you use a credit card for all purchases, this will be a bit easier to gather. If you pay contractors that only accept cash or check, you'll want to go back and keep track of these as well. Either way, gather all incoming and outgoing cash flows for this profit and loss statement. I like to use Google Sheets for this. It's simple, it's free, although there are paid applications that can do this for you if you reach that point with your business. You also want to keep a record of all documents. We're talking about the receipts for all those transactions. And I suggest setting that up in a specific Google Drive folder, so it's all right there when you need to file your taxes or in case you do get audited. The self-employment tax refers to taxes self-employed individuals and small business owners pay to the federal government to fund Medicare and Social Security. The self-employment tax is also designed to be collected from workers who are considered self-employed and do not otherwise pay withholding taxes. Now, this includes, like we mentioned, sole proprietors, freelancers, and independent contractors who carry on a trade or business. In any business, both the company and the employee are taxed to pay for the two major social welfare programs. We're talking Medicare and Social Security. In the eyes of the IRS, individuals who are self-employed are considered both the company and the employee, the employer and the employee, which is why they must pay both portions of this tax. And as of 2022, the self-employment tax rate is 15.3%. This is the sum of 12.4% for Social Security and 2.9% for Medicare. As the self-employment tax applies to net earnings, what many call profit, calculating your net business income is extremely important. Now, as a self-employed business owner, you also need to know how to properly and legally, that's key, reduce your net business profit on paper. This will allow you to reduce your tax liability and hopefully have more cash to reinvest back in your business. The primary way to do this is through tax deductions and credits. A tax deduction lowers a person's tax liability by lowering their taxable income. Deductions are considered above the line as they reduce your adjusted gross income, which then is used to calculate your overall tax liability. Tax credits, on the other hand, are considered below the line as they reduce the actual tax liability itself instead of the adjusted gross income. Another way to look at this is if you have a $100 deduction, you reduce your taxable income by $100. And if you're in the 33% marginal tax bracket, you save $33 in taxes by reducing your taxable income by $100 on paper. Now, if you have a $100 credit, you save the full $100 in taxes, as this offsets the full amount of taxes due directly. There are two types of deductions, the standard deduction and the itemized deduction. The The standard deduction is basically a flat dollar, no questions asked reduction in your AGI, adjusted gross income. If your business entity income flows through to your personal 1040, which is the case for most self-employed people, then this standard deduction works the same way. Itemized deductions, on the other hand, are more complicated in that you might have hundreds of expenses available to use, such as mortgage interest, student loan interest, and charitable donations. When you take the standard deduction, you opt to take a flat dollar deduction instead of picking and choosing from the hundreds of individual tax deductions out there. Typically, you just choose whichever offsets more of your adjusted gross income, whichever amount's higher. Now, as a self-employed, there are many valuable tax deductions for freelancers, contractors, and other self-employed people who work for themselves. We're gonna do a longer video on this, but here are a few big self-employment tax deductions to remember. The home office deduction. If you run your own business from your home or use it as part of your business, you should deduct a portion of your home office expenses. You could deduct a portion of your mortgage or rent, property taxes, the cost of utilities, repairs, and maintenance, and similar expenses. Generally, this deduction is only available to the self-employed. Employees typically cannot take the home office deduction if they work for a standard employer. If you use your car to run your business, such as driving to meet vendors, you could also deduct some of those auto expenses from your taxes. You could deduct 58.5 cents per mile in 2022 that were used for business purposes. If you might take advantage of this, try to keep a mileage log throughout the year. If you contribute to a retirement savings account with business income, you could deduct these contributions from your taxable income. Now, many small business owners use a solo 401k or a SEP IRA to save for retirement, and that also offsets taxes due each year. For example, you could deduct contributions to a solo 401k of up to $61,000 in 2022. You can add another $6,500 if you're 50 or older, or 100% of earned income, whichever is less. If that's confusing, watch our other video where we cover that in depth. If you want to learn more about which type of retirement plan is best for you as well as a self-employed business owner, we're going to link that below. While these are just 3 examples of self-employed deductions, there are many more. We'll do a separate video, so just make sure you hit subscribe now to check that one out. If you like our content, hit subscribe. My name's Tony from Wealthfront. Take care.